Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 28 of my Dow analysis series. In this video, we will be analyzing the fourth largest company in the Dow by market cap, which is none other than the healthcare giant Johnson & Johnson, ticker symbol JNJ. Johnson & Johnson is a multinational company that develops medical devices, pharmaceuticals, and consumer health products. Their business is split into these three segments. In the consumer health segment, Johnson & Johnson sells a broad range of products in skincare, over-the-counter medicine, baby care, oral care, women's health, and wound care. They have many major brands such as Neutrogena, Benadryl, Listerine, Band-Aid, and Neosporin. Actually, in 2021, the consumer health segment accounted for about 16% of Johnson & Johnson's total revenues. But about a year ago, in November of 2021, Johnson & Johnson announced that it will actually be spinning off the consumer health segment into a new company that will be called Kenvue. And this is expected to take place sometime in the second half of 2023, so probably still about a year until this happens. The main reason for this is that it should allow Johnson & Johnson to focus more on their pharmaceutical and medical devices segments and streamline that business more efficiently. The next segment is the pharmaceutical segment, which accounts for about 56% of Johnson & Johnson's revenues. This segment focuses on 6 therapeutic areas: immunology, infectious diseases, neuroscience, oncology, cardiovascular disease, and pulmonary hypertension. Medicines in this segment are distributed directly to retailers, distributors, hospitals, and others for prescription use. When we look at a company that's involved in pharmaceuticals, it's important to have an understanding of their pipeline, which is just a representation of drugs that are in development. If we scroll through this page here, which shows all their drugs in the pipeline, we can see that they have 107 drugs in the pipeline currently. So this dark blue means that it has been approved for use to some degree. The lighter blue is in phase 3, the teal is in phase 2, and the gray is in phase 1. The bottom line is that they have a lot of drugs in development, which is a good thing to see. The final segment here is the medical devices segment, which accounts for about 29% of Johnson & Johnson's 2021 revenues. This segment is mainly focused on developing devices in interventional solutions, orthopedics, surgery, and vision. These products are distributed to wholesalers, retailers, and hospitals, and are mostly used by healthcare professionals. Now that we know a bit about Johnson & Johnson's business, let's take a look at their performance in the third quarter of 2022. In this quarter, Johnson & Johnson generated revenues of $23.8 billion, which was up about 2% year over year. Their GAAP earnings were $4.5 billion, or $1.68 per share, which was an increase of about 22% from the third quarter of 2021. Aside from revenue and earnings growth, there wasn't too much else that was notable in the quarter. Overall, like we saw, they had solid results and a little bit of growth, which isn't really spectacular in and of itself, but I think given the macroeconomic environment and challenges that are present for a lot of businesses right now, I think that slow growth is a pretty positive sign moving forward. Looking now at the balance sheet, we can see that they have a cash position of $11.4 billion, which is down over $3 billion from the beginning of 2022, but we can see that they have converted all of that cash difference and then some into marketable securities, which are up over $5 billion since the beginning of the year. Current assets are sitting at a total of $65.2 billion, which is up over $4 billion from the start of the year. Comparing this to total liabilities of $45.5 billion, which were virtually unchanged since the start of the year, and we see that Johnson & Johnson has a stellar current ratio of 1.4. This means that they have more than enough assets on hand in the short term to pay off any of their short-term liabilities. We find total debt by adding long-term debt of $27.6 billion to their short-term debt of $4.4 billion, which is accounted for here in this loans and notes payables. And when we add those up, we get total debt of $32 billion. A good benchmark to see is that total debt is at a level that it can be paid off by the net income of the business in 2 years or less. And with net income in the range of $15 to $20 billion over the past few years, Johnson & Johnson meets this criteria, which is certainly a good sign to see. Not surprisingly, the balance sheet is very healthy at this point, and is certainly part of the reason that Johnson & Johnson is rated AAA by Moody's. It's one of only 2 US public companies alongside Microsoft to have that distinction. Looking now at some valuation metrics, Johnson & Johnson is currently trading around a 25 PE, which seems high to me at first glance. From a historical perspective, it certainly is far above Johnson & Johnson's average PE over the last 10 years of just 17. When we look at earnings per share over time and try to get an understanding of that growth, Earnings per share has grown from around $4.40 in 2010 to $7.18 today, which is a compound annual growth rate of about 4% per year. The big drop here in earnings per share in 2018 was due to some changes in the tax code, and basically they had to pay a lot more taxes in that year, and that kind of affected them in the short term, but really didn't have any effect on their long-term earnings trend. As a point of comparison, we can look at the healthcare sector, and currently that sector has a PE ratio of around 24. So in comparison to their sector, Johnson & Johnson looks to be kind of fairly valued. Moving on to the DCF model, as I calculated it, Johnson & Johnson has a fair value of $140, which goes down to $126 when we apply a 10% margin of safety, and this is substantially under the $176 that Johnson & Johnson is currently trading at, which does indicate that Johnson & Johnson is a bit overvalued at this point. Looking now at this 10-year chart of Johnson & Johnson stock, we can see this very long-term trend line here that has acted as support a few times, and interestingly enough, this trend line points right now to the $140 level as support, which is right around the fair value calculated by the DCF model that we just talked about. And if we zoom in here to the 1-year chart, there's not all that much to see here, but I think it is notable that there is some support in the $160 range, and there's lots of volume in the $165 range as well. And the stock does look to be approaching kind of an overbought level over the last few weeks based on the RSI here at the bottom of the screen. Johnson & Johnson is certainly a fantastic company with an extremely robust balance sheet and many promising drugs in the pipeline that could provide lots of avenues for growth. Even though they do appear to be a fair bit overvalued right now, I still think they are a great investment at these prices, and I think they would probably be a good investment up until the $200 price, most likely, maybe even beyond that price. However, at this time, I think there are a lot of other investment opportunities that are much more attractive than J&J, in my opinion at least. It is a very high quality company that I do own personally, and I definitely want to own more of it in the long term, but I really haven't been buying much at all in the past year because I've just seen better opportunities in the market. Let me know in the comments below if you have been buying J&J recently or at what price you would be more interested in the stock. If you haven't already, make sure to subscribe to the channel so you don't miss out on any future videos, and join the Discord as well. The link will be in the description below if you are interested in chatting with me about investment topics. Thanks for watching, and I'll see you all in the next one.